So the bulls have taken just a brief pause from their run, and a lot of analysts are processing this 3-week consecutive move up on the SPY and NASDAQ. In some cases, it's a historical move, and we all have commented that the move occurred on very low volume. And so over the weekend, there was a lot of comparison between this AI run that we have been in since 2023 to the dot-com bubble of 1999. And I thought I would take some time to go back and study the candles and the characteristics of price action during that time. And I have to admit, there are some interesting similarities as people have overlaid that dot-com chart onto this current chart. And it has, at least for sure, two very similar pattern moves. We had a move that took us down and gave a huge V-shaped recovery in 2025, followed up here by a smaller V-shaped recovery in 2026. Well, we saw that exact same thing back in dot-com era. At that time, it was a 4-week move higher, and then that was it. That was the top for the market, really, for the next 8 to 10 years, depending on what you're measuring and how you're measuring it. So I'm not predicting that that's the environment that we're in, but I can tell you that I personally want to be keeping a very close eye on the markets, and I want to understand if the past can give us some clues as to what we need to watch out for now. And for sure, there definitely are some clues from the past. I'm going to take you into the SPY and show that to you. I also have to talk about some companies reporting earnings this week that are definitely on watch. I'm going to go into a little bit of commentary on the most important one to me, which is Tesla. They're reporting earnings Wednesday after the market closes at 5:30. Hey, welcome to Wall Street. This is the Stocks with Josh show. I appreciate you watching my videos. Let me know how you did today on Wall Street. Did you make some money? I alerted 3 plays in the Stocks with Josh Discord. 2 of them, they didn't do well. 2 of them I had to cut pretty quickly, but we did cut them pretty quickly. But one of them continued to run, and it had a huge 110% move throughout the day. And it was just a reminder to me as I let the community know that you've got to be quick, you've got to pivot, you've got to be willing and able to cut positions that are not working out and load into the ones that are performing well. And I know that retail often is very slow to take those types of transitions and changes. They see a little bit of red and they're just so fearful of locking it in. They tend to hold and shut their eyes and just pray that it reverses. Not a good plan. And, I just want to encourage you guys that you do not actually have to have a very high win rate to have a very high ROI, return on your investment, but you do have to be willing to pivot. Come check out the Stocks with Josh community to get my next GOAT alert, as well as the fact that you can trade alongside me or one of my crown traders every single day, both in the morning and in the afternoon. And we have the friendly screener, which finds the stocks that are moving. Take a minute and watch this video. The market isn't hard because there aren't opportunities. It's hard because there are too many. And most people start their day simply wondering what to trade. That's why I built the friendly stock screener. This is the chart goats process turned into a tool, so you have a clear starting point for the day. Stop scrolling through countless tickers. Quickly narrow down to the stocks that top traders are watching right now. It's called the Friendly Screener because it has a built-in scoring and grading system that even a brand new trader can follow, as well as educational content to learn about the market moves that dominate Wall Street. You spend less time searching, less time second-guessing, and more time focused on the names that can actually move. Don't get stuck at the starting line and miss out on money-making opportunities. Use the Friendly Stock Screener. Better stock picks, better focus, better trades. All right, let me jump into the SPY and take you back in time and show you what I'm going to be watching for in the days ahead. Let's go check it out. First thing, I just want to show you this pattern because you're going to see it repeatedly. And a lot of other people have been talking about this, and they're going to be making their commentary. So I wanted you to get my commentary. We all know that we had this really incredible, very strong drop and V-shaped recovery back in 2025. And yet again here in the recent months, we had a smaller V-shaped recovery with 3 candles of huge price expansion higher on, we know, lower volume. And so this is the large comparison that people are making to the dot-com era. And let me take you back and show you the charts at that time so you can see with your own eyes whether or not that comparison makes sense. This little rectangle that we've got is the story that people are looking at for clues as to whether or not this market is getting ready to go into a dot-com era recession. Well, let's go over some of the major points. So this is the bigger drop, right? That's similar to our 2025 V-shaped recovery. And people are comparing the recent drop and the fast recovery and the brand new all-time high to this move that occurred back in the dot-com era. After a 10% correction, it had a very sharp reversal off of the lows and went on in 4 weeks, not 3 weeks, but pretty close, 4 weeks to make a very strong high. And people are saying that this red week that we've started this week is this red candle right next to the peak of that dot-com era reversal, right? And so the first thing that you want to notice is that if this was an accurate comparison and the markets were in any way repeating, that would suggest that the top that we just made last week is the highest price the markets will see for the next 10 years. Now, I'm not saying that. I'm helping you guys understand what lessons we could draw from the past so we know what to look out for. Now, the next lesson that I've particularly drawn is how violent the market got after those moves. This was a 10% drop, followed by a 15% up move, followed by a 15% down move. And depending on how you measure these, there was a number of 8 to 10% moves after that, before the markets ultimately went into a very strong decline. So here's the main points. The market isn't just going to roll over and free fall. If you are going to make some rotation in these markets, you're going to get numerous opportunities as it continued to stack higher lows and higher highs for months before ultimately rolling over. And what I want you to really think about in regards to the current AI bubble is that we have these big IPOs ahead of us: SpaceX, Anthropic, and ChatGPT, some of the largest valuations ever given to an IPO, $1.75 trillion, and the other two well above $1 trillion. It's the type of liquidity event that could mark the top of a market for a while and will bring a ton of people into the market. A lot of retail will be brought in. It's interesting to me that the pattern day trader rule was just changed, which means that you can bring whatever you got to the market and they'll take it from you if you're not careful. Instead of it being a $25,000 rule to allow you to make as many trades as you like, you will now in the coming months only have to have a couple $1,000s, and that'll allow you to make as many trades as you like or as many investments as you would like on leverage. So it is interesting how those events have coincided. I thought that the comparison of that past chart, and most specifically the way that it made an incredible high within a 4-week period, very similar to the high that we just made in a 3-week period. And back then we saw declining volume, and this time we saw even more declining volume. And so what this tells us is that for sure, if there is any comparison to be made between those two charts, the fact is the market's going to get more volatile, but we do have time. We do have time. Not calling the top, not really making any prediction other than increased volatility coming. So let's talk briefly about Tesla. I'm going to keep this very short, probably talk about Tesla in tomorrow's video, but I just want to highlight that this will be the first earnings event that will mark a full year of decreasing revenues. And we also know that Elon has already pivoted and let the market know that there's changes coming and that he understands that the stock cannot continue to climb under those conditions. So what specifically the market's going to be looking for is news about robotics, and they need to see in the environment of decreasing revenues and transitional expenses whether or not they can hold on to their margins or whether all that negativity needs to be priced in even more. I think that we're going to have opportunity to buy Tesla at a lower price. I'm not predicting that. I'm just telling you that it's paid for me to hedge my favorite upside positions like Netflix. It was a very good decision to hedge that position, and I think it's worth buying some insurance on Tesla this week. Now, the market's going to be watching for forward guidance and information on robotaxis and robots, and that could absolutely cause the stock to go higher. I'm not predicting that it'll go lower, but if you've got a large Tesla position in this environment, it may make sense to protect it and buy some insurance through the form of puts. Let me know what you guys think of that comparison of the .com and the AI market that we're in now. Do you expect price to continue to climb? I'd love to hear from you. Hit that like and subscribe. Come check out the Stocks with Josh community and the tool, the friendly screener. I'll see you in the next video. Peace and blessings.